Interested in trading options but don't understand pricing? New to options trading and looking to gain more understanding? This video will quickly break down the basics on option prices to further help you understand and potentially trade options in the future. Please make sure to watch my previous video introducing and breaking down the basics on options trading before jumping onto this one. This video is a little jargon heavy, there's a lot of financial jargon. Please either pause the video or make sure to go back and rewatch certain sections that you need help understanding. When you're buying an option, you're paying a premium. You're paying a premium for the contract. What are you paying for? You're basically paying for the right to buy or sell shares at a future date. On the flip side, if you're selling options, you're collecting that premium. An option's price is broken down into two clear parts, the intrinsic value and the extrinsic value. Starting with intrinsic value, the simpler of the two. Intrinsic is the value an option would have if it were exercised today. I'll be breaking it down further into the differences between intrinsic value of a call option and a put option. They're slightly different. Call option intrinsic value is calculated as stock price minus strike price. If you bought a call option, you have to choose the date and you have to choose the strike. If you bought an Apple option for a strike price of 400, you want these shares, you want Apple to go above 400. If at your expiration date, Apple is $405, you're in the money. But how much in the money are you? Based on the previous calculation I just showed, based on the previous formula, you'll be doing stock price minus strike price. You'll be doing 405, which is the stock price, minus 400, which is your strike. So you'll have $5 per share or $500 total. Remember, every option is 100 shares. On the flip side is put options. You bought a put option for Apple at 400 because you think it'll go down. In this case, the formula gets flipped. The formula for calculating put options intrinsic value is strike price minus stock price. If Apple ends up on your expiration date at $385, you're in the money. Your option value, your intrinsic value, would be strike price minus stock price. So 400 is your strike, 385 is your stock, your $15 or $1,500 in the money. Please keep in mind, you can't have negative intrinsic value. You can only have intrinsic value of 0 or more. My previous examples are of options in the money, but what if we guessed it incorrectly? If you bought a call option for Apple at 400, but it ends up being 385, you don't have negative 15 or negative 1500 intrinsic value. Your option's intrinsic value would be 0. Another item to note, your option value must be worth at least the money you can make off of it. If you can exercise an option right now and you can make $500 off of the shares, your option value must be worth at least $500. Why would anyone sell an option for less than what they can currently make on it? Hopefully nobody. If you tried to buy an option for $100, but the seller can make $500 off of it by just selling the shares because they're in the money, they'll never sell it to you. They're basically losing $400 in value if they do sell it to you. They can sell their shares for $500 instead of selling you an option and only making $100. They're indirectly losing money. So the minimum value of an option is how much you can make by exercising it. If your option is in the money by the expiration date, you will have a positive number. You're in the money. If your option is out of the money by expiration date, you won't be negative, your option will be 0. Let's prove this theory by reading an options table. I've briefly explained how to read an option table in my previous video, so I won't be repeating it here. But looking at SPY, it is currently at 321.72. If we look at the 321 strike, that means it's in the money. We can make at least 72 cents per share on this option. I expect this option to be worth at least 72 cents. As you can see, it is 183. Looking at the 319 strike, we're deeper in the money. I expect to make at least $2.72 for this option. As you can see, it's being sold for $3.24. Let's take a look at the put side. Remember how we flipped the formulas? If we bought the $3.24 put, we're in the money. I expect at least $2.28 in value for this option. As you can see, it's being sold for $3.27. Moving on to the more complicated of the two, extrinsic value, also known as time value. Options always expire sometime in the future. You can't backdate it. So from the time you purchase it to that expiration date in the future, you're paying for that time. It has more time to go from out of the money to in the money. You're basically buying time for the chance to make more money in the future. If you're buying an option, the further away the expiration date is in the future, the more extrinsic value you'll be paying, the more time you'll be buying. On the flip side, if you're a seller, you're earning this extrinsic value. The further away you sell an option, the more you'll earn. Going back to our previous example, take a look at SPY. On the call side, it's currently $3.21 per share. But look at the 322 strike. That's out of the money. The intrinsic value is 0. It's cheaper to buy SPY on the free market for $3.21 compared to the option for $3.22. But notice how it still has value? It's being sold for $1.30. This is extrinsic value. This is the time factor. There are still 3 days for this to go to $3.22 and above. There's still time for it to go in the money. Let's look further out. Let's look 10 days away. Using the same strike, $3.22. The option is still out of the money. It still has intrinsic value of 0, but the price has shot up. It's $4.08 to purchase now. That's because you're paying for the time factor. You're basically buying an extra 7 days over the previous option. You're paying more to have more time for your option to go above $3.22. That's extrinsic value. Making this more complicated, the more volatile a stock is, the more the time value is worth. If a stock has only been moving 1-2% a week, 1-2% a month, you can expect the extrinsic value to be low. However, if a stock has made a 10-15% jump in a week or in a month, you can expect that time value, the extrinsic value, to be high. This is because the more volatile a stock is, the more chances it has to become in the money. The less volatile a stock is, the less probability it will be in the money, the less fluctuation it has. Stocks that don't have much price fluctuation won't have that much opportunity to be in the money. The volatility is low and you'll be paying less or earning less if you're selling for that extrinsic value. What are our takeaways from this video? Option values must be worth at least their intrinsic value, and that intrinsic value cannot go below 0. Options with more time to expiration will have more extrinsic value, will be worth more than the same option, same strike with less time. Lastly, options where the underlying stock is very volatile will have more extrinsic value. You'll be paying more or you'll be earning more compared to options with low volatility. That's it for this video. It's just a basic introduction to option prices. You don't need to sit down and calculate the option prices, but you need to understand just the basics and the background of how it works. You need to understand the extrinsic value, which is more important in my mind. Why would, let's say, Bank of America have a lower option price 1 week away compared to Tesla 1 week away? You have to realize you have the chance to make more money on Tesla due to the high volatility, but also you'll have to pay more for that same advantage. Please check out my past video where I break down the basics of options. Make sure to tune into my upcoming videos breaking down the basics of call options and put options, but diving deeper in how you can make money off of it. Lastly, I'll be doing live trades on SPY and probably showing you how I do cash secured puts to earn income every week or every month. See you guys.